Adjusting interests are required in accounting because of the accrual basis of accounting. Under the accrual basis, revenue is recorded when they are earned, and expenses are recorded when they are incurred. Adjusting interest doesn't include the cash accounts. That is because when the adjusting interests are recorded, cash transaction has already taken place or will take place in the future. In this screen case, I'll go through two scenarios that require adjusting interest: deferred revenue and deferred expense. Deferred revenue refers to company receiving cash before they earn the revenue by completing a service on the delivering a good. Under the accrual basis of accounting, in the journal entries, the cash inflow into the business must not be recorded as a revenue. Instead, it must be recorded as a liability. This is because the business has not earned the cash. For example, suppose a company was paid $100 on 1st September to complete a service on the 30th September. The following journal interest will be recorded like that. As the business provided the service and the adjusting interest is recorded, the liability account is decreased and the related revenue account is increased like that. However, if the credit was wrongly recorded as a revenue in journal interest, then the adjusting interest will decrease revenue and increase liability by the opposite amount calculated. This shows the amount of revenue earned and the amount of money the business has yet to earn. Suppose the same company was paid $600 on the 1st September to provide service for the next 3 months. If the company recorded $600 as revenue originally, then at the end of September, the adjusting interest will look like this. On the other hand, deferred expense is where the company pays for resources before they are incurred and expensed. As the resource has not been used, it cannot be recorded as an expense. Instead, an asset is recorded. As the asset is used, the assets account is going down and the related expense account is going up. For example, suppose a company purchased an insurance policy for 6 months on the 1st July for $600. At the end of the month, should the company prepare a financial statement, then the following adjusting interest is recorded. If the purchase was incorrectly recorded as an expense, then the adjusting interest will increase the asset and reduce the expense account by the opposite amount to show assets remaining the expense incurred.